Have you ever panicked at a tiny red candle just to realize that the bigger trend was still up? That's exactly why the pros zoom out and use multiple time frames. Hi, I am Pranav VK, an NISM certified trader and trainer and your guide at Stockshaala by Kotak Securities. Today, we are diving into multiple time frame analysis, a simple secret for you to avoid the bigger traps and making sure that you're focusing on the real trend. So, what exactly is multiple time frame analysis? Multiple time frame analysis is just a fancy way of saying look at more than one time frame before trading. But why do you have to look at multiple time frames? It's because the market is like a storybook. It doesn't tell you the whole story in a single page. To give you a simple example, the daily chart is like the entire novel, whereas the hourly chart is like one of the chapters of that novel. And finally, the 5 minutes chart is just like a paragraph. So if you only read the paragraph, then you'll always miss the plot. I will share a simple process of how pros use multiple time frame analysis. They do it in three variations. First, they are looking at the biggest time frame, that is probably the monthly or the weekly time frame. After which, they zoom in a little bit to see the daily time frame. And finally, they zoom in even more to look at either the hourly time frame or if you are doing intraday trading, then the 5 minutes time frame. Let me help you with an analogy of Google Maps to help you understand this concept better. Imagine you're going out on a road trip. The first thing you're going to do is you're going to look at the entire country and decide which cities you want to travel. Once you have decided that, you're going to zoom in a little bit and look at how is the traffic in each of these cities. And finally, the city where you're going to start the road trip, you're going to turn on the Google Maps and navigate turn by turn. And that's exactly how pros use to navigate the markets. Now let's look at a real life example on the charts to understand multiple time frame analysis even better. I have taken the example of Nifty 50 index and on the monthly time frame. As you can see here on the monthly time frame, Nifty 50 was continuously bullish, touching the all-time high, after which it has started consolidating. Once we come to the 1 week time frame, we can observe that the last few weeks continuously Nifty 50 has been bearish. Now let's shift to the 1 day time frame and see how it is going to be different. Once I shift to the 1 day time frame, I can see that the market has been in a clear downtrend, creating lower highs and lower lows, and in fact even today the market tried going higher but rejected and came down and has turned the market into bearish once again. That's exactly how multiple time frame analysis can help you give better clarity on the entire market. Here are some common mistakes done by traders when using multiple time frame analysis. The first one is entering trades based on very low time frames like the 1 minute or the 3 minutes time frame. And even sometimes 5 minutes time frame are going to have noises. So it's important for you to use higher time frames before making any trading decisions. The second one is ignoring the higher time frames and trying to catch the tops as well as bottoms. The third one is mixing too many types of time frames. You should have a maximum of 2 to 3 time frames that you will regularly analyze, rather than having 6 to 10 different time frames and confusing all your decisions. Here's a pro tip. It's important that you remember that 2 to 3 time frames are more than sufficient. If you use more than that, then it is going to look like you're looking at 10 different cricket replays of the same ball. You might ask me, Pranav, sometimes I do swing trading, sometimes I do intraday trading, and sometimes I even do scalping. In these cases, what time frame should I really use? Don't worry, I'll break it down for you. If you are a swing trader, then it is crucial for you to use the daily time frame as well as the weekly time frame. But if you want to plan your entries and exits, you can also use the 1 hour time frame. But if you want to do intraday trading, then I would recommend that first look at the daily time frame, and once you have a hang of what is happening, then you can shift to the 15 minutes time frame as well as the 5 minutes time frame. Some intraday traders also like to use the 1 hour time frame. But remember, Choose 2 to 3 time frames that suits you best. And finally, if you want to do scalping, it is very similar to intraday trading, but it is even more high frequency. So I would recommend that use the 1 minute time frame along with the 5 minutes as well as the 15 minutes time frame. Very similar to intraday trading, but here your decision making will be even more better with the 1 minute time frame. So here's a quick recap of what we have learned so far. Multiple time frame analysis is what pros use to make sure they know the bigger picture as well as the smaller picture all together. Always remember to start with the higher time frame, zoom in and then go to the lower time frames. This way you know that you're not missing out on the bigger trends. Look for confluence across 2 to 3 different time frames. And finally, use it to trade with the trend and not against it. And as we all say, trend is your friend. So make sure that you're following the trend using multiple time frame analysis. You're watching Stockshaala by Kotak Securities, and if you like this video, share it with your friends, subscribe to the channel. I'm Pranav VK signing off, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.